Hello guys, welcome back to UCL Forest Academy. Once again, we are welcome back to the channel. So today's lesson, we're going to be talking about the real reason you are still not profitable with SMC strategy. It's going to be like an SMC breakdown where I'm going to be explaining a lot of things about SMC to you guys, the reason and the purpose why you have been unprofitable with SMC. I know that you already know what is SMC, but there are some certain things that you still don't really understand about SMC. Even if you already understood it, you could be struggling to know how to implement it. And that is what I have to explain to you guys on today's lesson. All you have to do is to watch the lesson to the end. Believe me, whatever I'm about to say today will really improve the way and the manner you approach the forex market and how you also take your entries and the kind of zones you mark out. All you have to do is to watch the lesson to the end. And don't forget to like and subscribe to the YouTube channel. Leave your notification button on so that each time I drop a new video, you'll be the first person to be notified by YouTube that I've already made a new content. Okay, so now we're going to be diving straight into the lesson, and then to see what we have on today's lesson, what's an SMC, and everything you need to know about SMC. All I plead of you is to make sure you watch the lesson to the end. Don't forget, this is not like the first time I'm making an SMC lesson here on YouTube. I've already this. I have. If you go to my YouTube channel, click on the channel. You can come to playlist. I have some SMC tutorial content there. If you come to playlist, I have SMC tutorial content that are there to enable you to understand some certain things about some I have some tutorial content here on YouTube that are here to enable you to understand what is SMC and some certain things you need to understand about SMC. Just click on the playlist and then you can be able to watch the lesson. Don't forget that our VIP class is still running. All you have to do is to use the number you are seeing on the screen to reach out to us on WhatsApp so that we can mentor you very well so that you can see the forex market and trade like a pro and manage the and managing a particular whole thing like a business, not the way it's being structured on the internet. Okay, so now let's explain every single thing that has been keeping you unprofitable with this very particular strategy, because I know that most of you guys might have come across several YouTube content or several YouTube lessons that have been trying to explain SMC to you guys. You already understand, but you are still struggling with it. Watch the lesson to the end and never underrate anything I'm about to explain on today's lesson, even if you already know that. Never underrate that. Okay, so now we have, first of all, we're going to be starting with the terminologies of SMC and try to understand the terminologies of SMC and why most traders doesn't make use of all these terminologies, but they use some of it as a confirmation for few of them they will choose. Because at the end of the particular lesson, I will be able to show you guys a lot of things you need to know about all these terminologies and a lot of things about these things. Then you could choose at the end of the whole day the one you want to be start making use of. One of the things that can actually help you on the forex market is when you choose one thing, you try to master that thing over and over again. Although I will still take you straight to the chart, you see the reason why you need to master that very particular thing over and over and again. Okay, so now SMC terminologies we have order block, we have a breaker block, we have a fair value gap, we have inducement, and we have clear of liquidity. Under this clear of liquidity, we have old highs, or which can still be called a sell side liquidity. We have old highs, which can still be called a sell side liquidity. We have old lows, which can be called a buy side liquidity as well. And we have draw on liquidity. Most of the lesson I've done here on YouTube, I've never been able to explain what is draw on liquidity. And that is what I'm going to explain to you on today's lesson, which you have to watch the lesson to the end. I'm also going to be trying to talk about order flow and how order flow is strictly different from equal highs and equal lows. You're going to understand how order flow looks like and how equal high POIs looks like. That is one of the key things you need to watch the lesson to the end, and the risk to reward ratio of the very particular thing. We're also going to try to understand the SMC rules, which is percent, consistency, and trading plan. I will take you straight to the chart on what has played before, and you see how long you need to wait for a setup. So certain things you need to consider. So please, what I plead of you is to make sure you watch the lesson to the end, and definitely you will understand whatever I meant on today's lesson. Okay, so now let's start with the terminologies. Then, step by step, we try to explain a lot of things you need to understand. Okay, so now what is order block? So, order block, you need to know where institution orders are, where institutional orders what are. That very particular place, the institution has placed in their orders. Now, you need to understand for the market to push to the upside, there were a lot of buyers or there were a lot of sellers that step in to take the market to any direction. Are you understanding now? there are what a lot of orders. The fact that you see that this market is making a series of high, a series of low, a series of high, a series of low, a series of high. There were others here that led this massive push to the downside, and there were others here that led this massive push to the upside, and there were others here that led this massive push to the downside, and they see an order here that has led the market to push to the upside. So you just need to understand that what this is where the order block what lies. This is where what the order block lies. This is where the order block what lies. So one of the things you need to understand about order block is that an order block must actually break a structure. That's number one rule. An order block must actually what break a structure. You can still say that an order block is the last opposite candle that led to a BOS. This part I will not really extensively explain on that because I've already done most of it on the SMC lesson, which you can go and check it out, SMC tutorial. Just go to this playlist and then you're gonna see where I explain how this order block looks like. But you just need to understand that it is the last opposite candle that led to a bearish movement or to a bullish movement. Or still, you can still define an order blocks to where institutional traders actually placed in their order. But let me just give you a little hint on how it looks like. So as you can see, this is I'll be using a plain chart. I will not be using anything like a diagram to explain. So for the market to push to the upside and then from there the market pushed massively to the downside and broke all these lows, this red candle was the last candle the market formed. This particular candle, this particular green candle was the last candle the market formed that led all this massive push to the downside that actually what break a structure. So this is what an order block, and this is what an order block. This candle you can see here. I try to hide this thing. So this candle, these two candles you can see here is what we call what an order block. These two candles are what we call an order block. And you can see after these two candles, we had all this massive push to the downside that actually break a structure. So again, where is an order block or a particular one? As the market printed to the upside, the market from here dropped to the downside. This very particular two candle here, this very particular green candle, this very particular green candle here is the order block that led price to the downside. So that is what you need to understand about order block. It's actually the last opposite candle that led to a bearish movement, depending if it's a downtrend. But if it's an uptrend, it is the last opposite candle that led to a bullish movement. Always understand that another block must break a structure, and if an order block did not break a structure, it is not an order block. So now I also want you to understand that in SMC we have what we call a breaker block. Now, most of you will be wanting to skip this lesson. That's one of the problems that is wrong with you. And this is the same course you pay thousands of dollars to pay to understand. And why won't you watch the lesson to the end? Is it because it's free? Watch the lesson to the end. You try to understand all these things, and you see that it is not really important that you can make use of all these things. You can just select few and then use the other ones as a confirmation of what you are doing. So when we talk about the breaker block on the forex market, breaker block are failed order block. And what are failed order block? It is another block, but it's not really what? It's not really a pure order block. It was like a failed, let me just say it is a failed order block. Now you need to understand that this breaker block is still the same thing as people that trade support and resistance. It's still the same thing as what? As people that trade support and resistance. As you can see, the market has been trading to the downside like this. The market has been printing a series of we had a BOS here, right? We had a BOS here like this. We had a BOS. The next thing the market came and the market could not break this very particular low like this. The market did not break this very particular low. And now you can see the market now pushed aggressively and broke a high here. This very particular high the market break as is what we call what a breaker block. It's what we call what a breaker block. Support and resistance traders call it a resistant turn support. A what? A resistant turn support. So this is what we call a breaker block. This is what we call what a breaker block. So for the you can mark it out like this. You can mark it for this particular week, or sometimes you mark out the candle that you spot here, but I'll mark it out like this. So this is what we call what a breaker block. This is what we call a breaker block. But an order block looks like this. Mostly SMC traders mark out order block from the extreme. Mark out order block from what? From the extreme. As you can see, there's a big difference between this and this. Can you see? There's a difference between this and this. So that is what you need to understand a breaker block. A breaker block are failed order block. Are what? Are failed order block. It failed to hold a price, and since it has failed to hold a price, it is likely to hold a price when price return like this and respect it and start pushing to the down to the upside. That is what we call a breaker block. So when we talk about a fair value gap, a fair value gap is like the space in between two candles or in between three candles. This is like an imbalance in the forex market, in which the market will always come back to rebalance that area. This is like a gap. Let me use that word, a gap in between three candles. Let me just say three candles. Do you understand? This is an example of a fair value gap. This is a pure example of a fair value gap. So as you can see, there was a consolidation of candles here. And the next thing after this candle, just pay attention. After every particular candle here, we have this massive bullish candle that's formed here. The next thing, this very massive green candle. Let's remove the breaker block and make things clear. So this we have this very massive green candle that's formed there. The next thing you can see, there was a space, there was a massive space in between these two candles. There was a massive space here. This is what we call a fair value gap. This is what we call what a fair value gap or imbalance. So as you can see, this is a fair value gap. For you can see there's a space between this candle, these three candles. One, two, three. One, two, three. One, two, three. So there's a space in between these three candles, and that space is what is a fair value gap. I will teach you how you can be going in for a buy or sell with a fair value gap and what you have to look out for before you start using a fair value gap. You will come to understand whether as an SMT trader, whether you need to be trading from other block, breaker block, fair value gap, you are still going to understand that. And all these things can be made possible if you can actually watch the lesson to the end. So as you can see, we don't have any fair value gap here. We don't have any fair value gap here. Price here was actually efficient. As you can see, there was no fair value gap. There was no space in between two candles here. As you can see, there was no space, but we have a fair value gap here as well. You can see a fair value gap. This is a fair value gap. This is a fair value gap. As you can see, there was a big difference between this very particular indecision candle and this very massive bearish candle and following by this candle. So there was a space here, and that space is the fair value gap. So as you can see, we equally have a fair value gap here as well. We have a massive fair value gap. So understand how this fair value gap, this is like a space in between three candles, a space in between what three candles. As you can see, this is what we call a fair value gap. This one is very, very massive. I will teach you how to go in for a buy or for a sell if at the end of the whole day you want to be start making use of a fair value gap. So if I can pause a little, is there any fair value gap here? Can you look at it? Is there any fair value gap? All right, this is a fair value gap. Just understand, I'm trying to use an introduction to explain to you guys everything you need to know about these terminologies. Then we'll proceed to how to go in for a buy with this very particular stuff. So this is a fair value gap, and this is still another fair value gap. Are you getting me now? So these are fair value gaps on the chart. So, and these fair value gaps are often referred as what imbalance in the forex market. So when we talk about inducement and clear liquidities are all the same, just that they are not really the same. Okay, they have the same similarities, just that they perform different functions. So when we talk about inducement are where the smart money lure you in to go in for a buy or for a sell at very early stage. Now let's look at what really happened there. Let's look at what really happened here. So as you can see, when the market break a structure to the downside, there were a lot of early sellers trying to sell market to the downside. The fact you can see this red candle, there were sellers, they were trying to sell market, and their stop losses was resting above here. The next thing, the market took them out, and then the market came so close to our point of interest and dropped to the downside. This is another fair value gap here. So when the market was dropping here, these guys that were busy shutting down the market here, they have been induced. They have been what? Induced. This is what we call an inducement. This is what we call what? An inducement. Always try to visit my SMC tutorial content. It is going to help you to understand what's an SMC, what's an inducement very well, the different types of what inducement. So this is what inducement, and let me show you more of inducement. This again is a pure inducement. This is a pure inducement. So as you can see, these people that we are shutting down the market, they knew that this market is going to sell for a long period of time like this. These guys that were selling the market like this, they knew that the market is going to sell. But what the market is that the market has to go up and then took them out with a week. As you can see, the market took them out, mitigated the extreme zone, and dropped massively to the downside. That is what an inducement can actually do for you. So you can see, let me use the diagram now. When the market is trending to the upside, let's say the market break a structure like this, and then the market is now returning back. For the market to get to the very particular zone, first of all, you will see a little retracement like this, a failed retracement. The next thing now, the market will now consolidate a little, do like it wants to go up, and then they will now tag everybody out, mitigate the extreme low, and start pushing to the upside. What the market did is that the market has actually induced a lot of traders into going for a buy at early stage, and when they take them out, they have been what? Induced. But when you talk about clear of liquidity, that one is very, very different from inducement. And I think I need to find the clear of liquidity for you guys on the chart to show you how clear of liquidity works. So clear of liquidity is that the market doesn't need to induce it in. They don't need to what? They don't need to induce you in. Their own is that they will just tag you out, they will just take you out, and they will still go in your direction. So as you can see, this is a pure example of clear of liquidity. So there was a consolidation around it for a particular phase. There were people that sold the market. So just imagine that you had a friend that was on massive profit. He wanted to take a profit from here, then he left the screen and then maybe went out to get something. All of a sudden, when he came back, the market has already tagged him out and still dropped massively down to his favor. This is what we call what? A clear of liquidity. This is when the market tag you out with a week and still move in an opposite direction that you were anticipating. Are you getting me now? So this is what we call a clear of liquidity. Let's see whether we can spot more of it on the chart so that you will get used to it, and then you will know that definitely that this is what we call a clear of liquidity. So the same thing that actually happened there is, you can see we have markets sold like this. There were people that went in for a buy. There were people that went in for a buy here. Now the next thing the market did, that the market tagged all of them out like this. The market sweep all of them out. Immediately the market sweep them out like this. The next thing we saw a massive push to the upside. This is what we call what? A clear of liquidity. Always understand that clear of liquidity will happen with a week. It will happen with what? With a week. It does not happen with a full body candle. These are like the things that always make you unprofitable, and then you keep on marking what happened without a full body candle, like what happened with a full body candle. What happened with the full body candle is never a clear of liquidity. The same thing again, we have a clear of liquidity around a particular area again. This is what we call what? A clear of liquidity. For the market to weak all these sellers, for the market to weak all these buyers out here, you see, this will call what? A pure clear of liquidity. And you see the market clear them out, and the next thing the market push massively to their favor. So this is example of what? Of clear of liquidity. Always understand it's definitely going to happen with a week. Now let's retrace back and try to explain more of the terminologies before we now go down to how to make use of all this stuff. Okay, so now you can see we now try to explain. We talked about under this clear of liquidity, we have old highs, and we have old highs which can still be called a sell side liquidity, and we have old lows which can still be called a buy side liquidity. Now with what you can see here, with what you can actually see here, this is what we call a sell side liquidity. This is what we call what? A sell side liquidity. These guys that sold here, their stop losses are resting above here. These sellers that sold like this, their stop losses are resting above here. Their stop losses are what? Are resting above here. And as you can see, when the market tagged them out, the market now moved massively to their favor. So this is what we call what? A clear of liquidity. And this can still be called a sell side liquidity, or can still be called an old low, or can still be called what? An old low. So always understand that whenever the market takes an old low on an old high, it is definitely, sorry, going to be called what? An old high. So let's understand that whenever the market takes out an old high, there's a higher tendency that the market will drop down to the downside. The market is going to drop massively to the downside because the market has actually grabbed liquidities above that what? High. So if this thing is on a downtrend market, it's going to be an inverse of it. This thing will be on a down. Like let's go to GDP JPY. Let me show you example of old low. So okay, and you will come to understand that the same thing as old low can still be called a clear of liquidity. It can still be called a buy side liquidity that has been what? That has been taken. So this is it now. So let's go back to 4 hour time frame. Let me show you what really happened there. So you can, as you can see, look at what happened. There were a lot of buyers, or there were a lot of buy orders here, and this market has been trending massively to the upside for a very long period of time. So a lot of stop losses is resting below here. A lot of what? A lot of stop losses is resting below here. So what the market did, that the market came and grabbed all their liquidities like this, and this is what we call an old low has been taken. An old low has been what? Has been taken. And what type of old low has been taken here? This is what we call what? A buy side liquidity old low has been taken. So just you need to understand that, as you can see, the market grab it with a week. Always remember, it is always going to happen with a week. It's definitely not going to happen with a full body candle. So this is what we call what? An old low. A very pure example of what we call an old low. So we are still taking our time to explain some certain things that you may not know, but you don't know how to make use of it, in which I'm going to show you how you can actually make use of all those stuff. Now let's retrace back to our explanation to try to understand some couple of things before we now explain how to make use of it. So now we have what we call a draw on liquidity. What do we mean a draw on liquidity? This is where the market actually moves to where there is liquidity areas. This is where the market what? Moves to where there is what? Liquidity areas. You need to understand that the fact that the market is pushing to the upside, that the market wants to go and grab liquidity. The market will move from one liquidity point to another liquidity point. Now, what do I mean by that? Now, for you to see that the market trended to the upside like this, for you to see this thing like this, for you to see this stuff like this, for you to see that the market is trending to the upside like this, the market has grabbed liquidity above this high. Let me expand so that you can see it very well. So these guys that sold the market like this, their stop losses are resting above here. They're what? Their stop losses are resting above there, and the market has grabbed their liquidity. Now the markets need to come back. The market need to what? Come back. The market need to what? Come back. And when the market is coming back, the market is going back to where there's a liquidity area, to where there's a what? A liquidity area. And those liquidity area can serve as a fair value gap, can serve as a what? A fair value gap, or can still serve as an unmitigated zone, can still serve as what? As unmitigated zone. You need to focus more on three things I'm about to explain now. Now, the market will move to three places or more than three places. Number one, it can move to a fair value gap. A fair value gap are pricing efficiency, which can still be called an imbalance. And that very particular place is where the market need to come back to rebalance, where the market need to work to come back to rebalance. As you can see, if the market return back here, the market has rebalanced in a particular area, and it has grabbed liquidity from there to gain energy to start pushing to the upside. And when we discover an unmitigated area, an unmitigated area are price levels where the market has not touched for a long period of time. Now, let me show you what actually happened on GDP JPY so that you come to understand what and the power of an unmitigated area. An unmitigated area will always be a liquidity area because that is the area where the market has not mitigated for a very long period of time. So as you can see, look at what really happened here. After all this massive sell to the downside, afterwards all this massive, I think we saw this setup on 15 minutes time frame. Okay, let's look at it here now. So after all this setup here, the market went massively and manipulated all the orders that was resting above this very particular high. After the market grabbed that orders, we saw this massive sell to the downside, and as you can see, the market was consolidating. Where is an unmitigated area? This is the way we call an unmitigated zone. So this is an inducement area. This is what an inducement area, and this is what we call what? An unmitigated area. And what we call what? An unmitigated area. And as you can see, after the market just came, mitigated, and it dropped to the downside. So that is number one thing. You need to understand that an unmitigated area are what? Are number one places of what? Of draw on liquidity. And another place again is what? An fair value gap is what? A fair value gap. Sometimes you go in for a buy. Let's say the market is selling like this. Let's say you came to the chart and the market is dropping like this to the downside, and then you are trying to sell from here. If you are trying to sell from here, your take profit should be at this low. Your take profit should be at this low, because this particular low, there's a lot of stop losses resting below here, and you need to know once the market grab that stop losses, it's going to retrace back to gain energy to start pushing to the downside. And if there's a fair value gap out in when the market was dropping like this to the downside, the market will want to come back to grab that fair value gap before dropping again to the downside. Let's say the market push up again, and if there's a fair value gap resting below here, the market will still want to chase that very particular what? Fair value gap. One of the things you need to understand is that each time you mark out your point of interest and there's a fair value gap above your point of interest, it is like it is giving you a lesser probability that that very particular point of interest will play out. Honestly, each time you mark out a point of interest and there's a fair value gap just above that point of interest. Now let me show you, like, let's try to find out where that kind of thing looks like. Like, you mark out a point of interest and there's a fair value gap above that point of interest, it is like giving you like a lesser tendency that that fair value gap, that very particular point of interest will hold, because that fair value gap is going to serve as a liquidity area. It's going to serve what? As a liquidity area. I want to find out where that very particular stuff is. So let's say you came to the chart now. This is a fair value gap, right? This is a fair value gap. So let's say you came to the chart and you were trying to mark out here as a fair value gap. You need to understand that this thing might work now, but it might not consistently be working for you. So always understand that since there's a fair value gap above that very particular high, there's a time that the market will just come. The market will mitigate that your point of interest like this, so it will drop and then try to manipulate that your point of interest just to mitigate a fair value gap before dropping to the downside. You just need to understand that such a thing can actually what? Can actually happen. The market will just mitigate that your order, sell a little, and then spike above that zone to grab that very particular what fair value gap, because the fair value gap is the number one place of what of draw on liquidity. Another number one on another particular place of draw on liquidity are what we call equal highs and equal lows. Equal highs and what and equal lows. Let's go to good and let me show you what I mean by equal highs and equal lows. I think I have it on GDP USD here. What I mean by equal highs and equal lows is when you mistakenly mark out a point of interest that is what? That is an equal high and equal low. You need to understand there's a big difference between an order flow and equal highs and equal low. You need to just understand there's a big difference about these two things. So when you mark out an equal high or equal low, that particular point of interest will play out. So, but the market will just come and manipulate that very particular point of interest and then drop massively to the downside. Now let me show you where this comes. I want to get a cleaner one about this thing. All I want you to do is to watch the lesson to the end. Don't forget our VIP class program is still running, and this is the best opportunity for you to learn how to trade the forex market and master how to trade this particular game. We're going to mentor you privately, and you're going to understand how to trade the forex market very easy. Imagine you getting a private mentor that is there to teach you on how to trade the forex market. Okay, so now as what you can see here, I'm just trying to find out where this equal highs and equal low is. Okay, now look at it now. This one is not even clear. This is not really clear. I just want to find out where. Fine, that's correct. That you can see now. So look at this. Look at this GDP USD setup now. So as you can see, the market dropped to the downside, and we had a break of structure here. We had a break of structure around this particular zone. The next thing, the market came up. Sellers took it down. This will now serve an inducement area of here. Let me zoom out so they can see very clear. So you can see we had a BOS here. We had a BOS. The market sold massively to the downside. And then when the market come up like this, we consider it as a what? As an inducement area. That is number one thing you need to see as an SMC trader. After marking out your break of structure, you need to focus more on looking out for the liquidity area, which is what which is this. So as you can see, as the market came up, the market fell to the downside, which is a failed retracement that will be considered as what? As a liquidity area. So as you can see, the market came up again, and now the market has now formed an equal high what? And the market has formed an equal high liquidity area. As you can see, this is what we mean by what? Equal high. One, two. This is what we mean by what? An equal high. So when the market came back, the market actually mitigated that equal high and started selling. The next thing we saw as the market manipulated above that equal high and sold massively to the downside. So this is what we mean by what? Equal high. I want you to play around this thing. Go to the chart, try to discover where this equal highs is. It will enable you to understand. Fine, we have gotten another one here. So look at it here. Look at it. Look at what really happened around the particular zone. So as the market was really coming up here, now see, the market has actually mitigated an order here. The market came mitigated an order here. Normally, most of you will start marking out this particular week as a point of interest, like an hidden zone. You'll be marking out this week like this as a point of, because most of you want to go in from this particular week. But what the market did there, I think this is not really clear. This is not. This is just like a liquidity grab above that zone. Let's try to find out where these equal highs actually played out very, very well. So I just want you to take your time, go to the chart, try to backtest where this thing actually happened. This will enable you to at least understand that this is what we mean by what an equal high and equal low. Example of equal high is equally here. So as you can see, we have an equal high here. Look at it. This is on a 2-hour time frame. As the market sold, the market pushed up again, the market retraced, pushed up again, and sold to the downside. Can you see we have a break of structure here? We have what? A break of structure. So most of us here, we're marking out this point of interest as a valid one. It is not, we are not wrong to mark out here as a point of interest, but we just need to understand that this is what we mean by what? An equal high POI, or an equal high what? Liquidity area. So that is why you saw the market manipulating above that high and sold massively to the downside. Even the market manipulated above this high again. This is even where the equal high was even very clean. Look at the equal high, very, very clean here. As the market sold, the market retraced. Look at equal highs here. So if we are marking out equal highs as a POI, there's a higher tendency that you are going to lose that setup. I will show you how to differentiate an equal high to work to an order flow. So now let's go to order flow now. Let's go to order flow because we have spent so much time in talking about these equal highs and equal low. So please try to play around this thing. Just remember that I'm not going to explain everything on this particular play, because if this particular lesson is too long, most of you wouldn't even want to watch it to the end. Okay, so now this is what we mean by what? Order flow. This is a clean example of what we mean by what? Order flow. So there's no equal highs or equal low here. As you can see, the market came, mitigate an order, push to the upside, retrace. This is what we mean by what? Order flow. Can you see this is a pure example of what we mean by order flow? This is again on USD CHF. Let me spend some time to show you. This is what we mean by order flow. And this is again what we mean by what? Order flow. Can you see how those candles are looking like the candle came and place above it? So this is what? Order flow. So if you came back and started marking out somewhere around there, like you mark out somewhere around there as a point of interest, you mark out somewhere around there as a point of interest. Number one is that you are right because you are marking out, you are relying on the internal structure. But what really happened here? This one by what? Equal high. This one by what? Equal high what? POY. As you can see, this will be by what? Equal high POY. And as you can see how the market can manipulate above it and drop to the downside. Please don't be marking out equal high liquidity area because there's a higher tendency you are going to lose that very particular setup. So this is order flow. You can see order flow. We have an order flow here as well. So that is how an order flow looks like. Let's trace back to Euro USD to try to explain how to make use of all these things. And one of the key things you are not really paying attention. And what is this thing you're not paying attention is what we call what? Is what we call number one is that you don't even know how to mark out a proper setup. Now, when you say you want to be trading an SMC pattern, when you say you want to be trading, you want to be a pure SMC trader. Number one is that you need to see a break of structure like this. That's number one rule. You need to what? You need to see a break of structure. After seeing a break of structure, you need to see a liquidity. You need to see what? A liquidity. Now, this falls whether you want to be trading from a breaker block or whether you want to be trading from a point of interest. Now, if you want to be trading from a breaker block, here is how it works. When the market break above the particular zone, most of you will start marking out a breaker block. But before you take a trade from a breaker block, there's something you need to see. What you need to see is a liquidity. You need to see what? A liquidity. And what is that liquidity? You need to see the first failed retracement. You need to see what? The first failed retracement. That first failed retracement can look like this. The market will come so close to mitigate that very particular breaker block like this. The next thing, you will now see the market pushing massively to the upside. Now, the moment you see this kind of thing, this is what we mean by what? Inducement area of this particular what? Breaker block. If you fail to see this particular thing, there's a higher tendency that that breaker block will not hold. Are you getting me now? This is like an entry pattern for a breaker block, and you need to choose one. The truth of the matter now, if you form the habit of trading breaker block and other block, you'll be taking unnecessary trade every time. And when this one fail, you look at, so you need to master one. You need to go and back test it and see the one that has a higher probability winning rate. I will not tell you. I have my own. I trade from other block. I don't trade from a breaker block. It's left for you to find out. I'm here just to give you an information, a valid information that I've gone to backtest and I've seen how it plays out. And what is left of you is to go and backtest it or to try to check out whether this thing is what is profitable. So this is what we mean by what an inducement for that very particular what breaker block. So what you have to see now is that wait for a retracement like this, place your order at that very particular breaker block. When the market will test it, you buy massively to the upside. This is still the same thing as what? As support and resistance what levels. But you need to understand that if the market now form a habit like this, let's say you came to the chart and then you saw, let's say the market is selling like this, and then the market break a level. Then the market now break this particular level. I think I'm being limited here. Let's go to a more clean area. So let's say you came to the chart, the market now is dropping to the downside like this, something that look like this. And then the market is now trying to return back to a particular breaker block. Then you did not see any inducement. There's a massive push. The market came and break that very particular breaker block. Once the market break that very particular breaker block, the one thing you need to know is what? Start looking at the other block. Start looking at what? The other block. Once the market break the breaker block, start looking at the what? Start looking at the other block. So if you have a failed retracement like this, just consider it as a inducement area. Just consider it what? As an inducement area and wait for price to return back so that you can sell to the downside. Are you getting me now? Or better still, let's say you have multiple breaker block like this. Let's say you came to the chart and the market is pushing massively to the upside. Let's say the market push like this and then the market bought massively. Now the market could not even get to the particular breaker block. It pushed again to the upside. And again, the market could not get to the particular breaker block. It pushed again to the upside again. No, you need to understand we have an order block here. There's another block here and there's another order block here. This other block can still be called a POY. there's another block here, and there's still another block around this very particular area. So now with what you can see here, we also have a breaker block here. We have a breaker block here. We have another breaker block here as well. So as you can see, the moment you have multiple things like this, the only thing I advise you to do is to wait for a liquidity to be formed, because as you can see, these are what a multiple orders around this zone. And for me, actually, I would want to wait for the market to retrace back to the extreme, because that's how most SMC traders normally trade from. But even if you cannot wait for this market to get here, all you have to do is to wait for a retracement. Wait for what? Wait for a retracement, a failed retracement that will now induce early buyers. This will now serve as what? A failed retracement. But let's say that failed retracement break the breaker block like this. It break it, break the other block again. Then you look at the previous what? Other block. Are you getting me now? You look at the previous what? Other block to purchase price the what to the upside. And let me show you where all these things actually work on the chart, so that you will know the essence of you looking out for a liquidity in the market. Also, you need to understand that whatever I'm showing you here does not have 100% winning rate. That is the one thing you need to know. It does not have what? 100% winning rate, but it only determines when you stick to those rules and you keep doing it over and over and over again. And there's a higher tendency you will get a 35% winning rate. So as you can see, we have a breaker block here. We have a what? A breaker block. So this retracement will serve as an inducement area. The market came so close and could not mitigate that very particular order. Remember what I told you guys about fair value gap. Fair value gaps are price inefficiency or like an imbalance area, and will always serve as an draw on liquidity. And each time the market came so close to a fair value gap, especially when the market mitigates the 50% encroachment level of a fair value gap, there's a higher tendency that market is going to sell to the downside. So let's say we have a fair value gap like this. Let's say we have a fair value like this. This is the fair value gap now. This one we can see here. This is the fair value gap. So this is the fair value gap like this. So one moment you have a fair value gap like this, you mark it out with a rectangular tool like this. All you have to do is to pay attention to the half of that fair value gap. Is to what? Pay attention to the half of that very particular fair value gap. The moment you pay attention to it, you are paying attention to a 50% encroachment level. You are paying attention to what? To a 50% encroachment level. Place your order at the half of it and place your stop loss above, and now target to the downside. This is like the entry pattern of a fair value gap. So if we try to go back, you see where you played out. We have a fair value gap as well. So as you can see, when the market came to that fair value gap, the market respected that very particular level. I've not forgotten the breaker block. Oh. I just want to show you things that really happened. So as you can see here again, so as you can see, the market respected a fair value gap here, the half of it. So always trade from the half of a fair value gap, not immediately the market mitigate a fair. One mistake you will make when you are trading a fair value gap is that you spotted when the market just tap a fair value gap, then you jump in immediately. No, your stop loss number one is going to be very massive. It's going to be what is very, very massive. But when you look at the half of it, your stop loss is not going to be as massive as when you are taking the entire fair value gap. Are you getting me now? And there's a psychology behind the 50% of the fair value gap. Always make sure you activate the middle line. So for the breaker block here did not hold, that our breaker block here did not actually hold, is because the market actually mitigated a fair value gap, and he used the 50% of it. As you can see here, this is it. This is the 50% of the fair value gap. Immediately the market tapped into the 50% of it, it dropped massively to the downside. It dropped massively to the downside. And always understand, for that fair value gap to hold, the market need to break a structure. You need to work, you need to break a structure. If that market did not break a structure, that fair value gap might not actually what hold. So as you can see here, we had a fair value gap here, but this one did not actually what hold. Just for you to know that some strategy will always fail, and there's nothing that is 100%. But I'm going to show you what will enable you to always stay profitable in the market, because you need to understand that the fact that all these things, the fact that you have come to know all these things, you also need to know that there is a higher tendency that it will not always be playing out every time. So as you can see, we have another fair value gap around this particular area, and the 50% of the fair value gap was what was respected, and the market dropped to the downside. So always go and backtest this thing, and believe me, you will see the result of it. So our breaker block here fails to hold because the market actually used a fair value gap. Let's now check out where a breaker block actually played out with a confirmed inducement that actually enabled us to know that the breaker block was about to what hold. Always know that you have to spot an inducement area that will enable you to know that that breaker block will hold. If you fail to see an inducement area, you might not be able to take that very particular setup. So as you can see, it is taking me time to find out that very particular stuff, but we have something that look like this here. So we have a breaker block here. This one is not really clear like that, but we have a breaker block around a very particular area like this. As you can see, this is a breaker block. And pay attention to what really happened here. Pay what attention. When the market break above the particular breaker block, the market tried to come back. Then people went up and took the market up, and the market started buying. Now there were a lot of stop losses that is now resting below here. So as you can see, this is number one example of what I mean. So the market now came back, tapped into the breaker block, and now pushed massively to the upside. Another one again is here. This one is not really clear like that, but this is a proper example of a breaker block as well. This is a proper example. This one is even very clear. Now let me show you. Let me show you on 30 minutes so that it's very, very clear to you guys on 30 minutes. So just understand, whenever you spot a breaker block, try to look out for your liquidity. That liquidity will enable you to hold that breaker block will hold. So now you can see, look at it here. Very simple. And then let's try to explain it very, very proper. So look at it now. This is a breaker block that is actually here. So what really happened here? This one is not really even clear, but we have to take it. Although when you go and check it out more, you will see. So when the market came so close, the market pushed up. A lot of people stop loss is just resting in front of every particular breaker block. Next thing, market tapping and bought massively to the upside. I want to find out the one that worked very well. I think I have many, many examples of it here. It's taking me time to find. So anytime you spot a breaker block, always make sure you find out your. Let's go to GDP USD and see whether we can be able to spot that pattern. All right, so let's check it out. Don't forget, our online class program is still running. All you have to do is to use the number you are seeing on the screen and reach out to us on WhatsApp. And believe me, you will definitely know how to trade the forex market. Things is going to get easier because you can see I'm taking my time. I'm brushing the lesson. I don't want to take much time because I know that most of you wouldn't even want to watch this lesson to the end. But when you are under us, there's a higher tendency everything will start clicking. So this, you see, we have a breaker block around this area. As you can see, after all this massive push to the upside, the market came and induced people in there. Next thing, the market tapping and bought massively to the upside. So that is what a breaker block can actually do for you. We still have a breaker block around this area again. We still have a breaker block here. As you can see, this is a breaker block. This is a breaker block. And as you can see, as the markets come up here, will serve as the first inducement area. The first failed retracement. The first word failed retracement. As the market tapping, the market switch to the downside. So that is what we call by what a breaker block. So let's look further. We can see one more example of a breaker block. Then now we'll now start to explain for the rest of it. Okay, now very cool. You can see we have a breaker block here as well. We have a clean breaker block here. So after the market break above the breaker block, the market came back, could not actually get to that breaker block. This will mean by what? Inducement area. After everything, the market came back, tap into it. I know you cannot see the tapping here, but you can see when the market came back, tap into that very particular fair value gap and push massively to the upside. Here is another breaker block that actually was played out very perfect. As you can see, this is another breaker block. For the market to come up, a lot of sellers were trying to bring down the market very, very early. And here will serve as inducement area. It made the market tap the breaker block, it dropped massively to the downside. And this is the part that the fair value gap actually played out very well. You can see we have a massive fair value gap here. Immediately, the market tapped into the 50% encroachment level of the fair value gap. It sold massively to the downside. Now, the big question here is, should I be making use of all these things on the chart? Now, I've explained to you a fair value gap, I've explained to you a breaker block, I've explained to you an order block, pattern of entry of all these things. But should I be making use of all these things? Should be a big question that you should be asking yourself. Now, you need to take one. You need to what you need to take one. Why do I say you need to take one? The truth of the matter is that when you form the habit of taking trade from here to there to there to there to there, your trading plan will never work and you will never have a specific strategy. There are people that love trading a fair value gap. That's number one thing. And when you have chosen you want to be trading a fair value gap, you need to be looking at the 50% of the fair value gap. When you said you want to concentrate on a breaker block, that means you need to see a failed inducement area. The moment you see a failed inducement area, you focus on that breaker block to take it to the downside. Now, when you say you want to trade from the extreme levels like another block, that is the part you want to see a proper break of structure and you want to see what? An inducement area. That is the least, that is the most highest way you will be what? To be profitable. But there's something we call a risk to reward ratio, which is falls under risk management. And if you go to my YouTube lesson, there's a particular lesson I did on risk management. If you come down here, come down to I think if you are new to forex, and then you're going to see there's a particular lesson I did on risk management. I took my time. Forex was hard until I met these three steps. All you have to do is to go and watch this lesson. It is still going to enable you to understand this risk management very, very well. So, what do I mean by risk management? Now, you have known all these things. You have known that I shouldn't be taking trade from equal highs and equal lows. That this equal highs, no matter if it is the POI that break a structure, that it is a higher tendency is going to fail, just like on gold. Let me show you one more example on gold. Then let's now try to explain what can actually keep you on a profit for a long period of time. Because number one is that these strategies are going to fail. But when these strategies click once, the moment you have one that played out, okay, you are going to see a massive profit. This is another breaker block that played out very well. You can see we have an inducement area here. As the market tap into the breaker, it's dropped down to the it dropped massively to the downside. So as you can see, we have a gold setup here. Look at a gold. Look at gold. I've been looking at this particular gold setup here, and it's very, very clear. Look at another breaker block that played out very perfect. The market came. You can see the breaker block. As the market tap in, the market sold massively to the downside, serving here as a what? As an inducement area. Then this is what we mean by what? Equal high area. This is what we mean by what? Equal high. This is what we mean by money. If you are trying to take a trade from here, this thing can actually play out too, but the truth of the matter is that they might want to manipulate your orders, because anyway there's an equal high, there's a large liquidity resting above there. So as you can see, I have been looking at gold like this and I've been considering taking a trade from there. So we have a BOS. Number one, we have a BOS, we have a BOS, and as you can see, with this one, we have what? Equal high area, equal high what? Liquidity area, and this will serve as an inducement area. I can never be found taking trade from here because there's a high tendency that that area will be manipulated. So now, when we now talk about risk to reward ratio, risk to reward ratio is that whenever you take a trade without your strategy that you have taken, it's either a breaker block, it's either a fair value gap, it's either an order block. The moment you take a trade from there, always aim to target at least 1:2 or 1:3. Do you understand? Always aim to target 1:2 or 1:3. Now, you always see me on my free Telegram channel that I normally drop free signals here on my free Telegram channel. If you have been looking for any free Telegram channel where you want to be getting free signals, use the link on the description below and join the very particular free Telegram channel. Definitely, you'll be catching some good trading setup because I normally share free signals here. So the moment you have a setup like this, now, the moment you have a setup like this, you can see my stop loss. My stop loss is just like a 1% of this particular stuff. Now, what I'm aiming here is 1:4. What I'm aiming here is what? Is 1:4. Now, that means that if I decide to risk something like 1, I'm targeting 4. I'm targeting what? 4. If I risk 1%, I'm targeting 4%. Do you understand? So even if this particular setup plays out now and I make 4% here, this market hits TP now, and I make 4%, then do you know what is going to happen? If on the next trade I loses the next trade, I will not bother because I've just lost 1%. Do you understand? I've just lost what? 1%, and I still have 3% left. Do you understand now? This is like the best way you will stay in profit with a particular what strategy. But if you are like, if you anytime you go in for a buy and then what you are aiming is 1:1, or maybe a little push to the upside, maybe a little profit to close it, you can never be on profit. You can never be what? On profit. Last week I told people here on my free Telegram channel that I had total trade, like I dropped 5 trade for you guys here on this particular channel, and we have 3 SL hits, right? This particular 3 SL hit was 1% each. Now, most of you that doesn't know how to use lot size might, when the first stop loss hit, you went and increased the loss size. That's because you don't have a trading plan. You went and increased the loss size, and then when the market now hits your stop loss, you start crying. It's wrong. Then on the next trade now, you reduce your loss size. If you continuously doing this thing, you can never stay on profit. You reduce your loss size. That one now went to your favor, and then you couldn't recover your losses. It's wrong. So you have to have a stable loss size and you have to have a stable trading plan. So when here I'm risking 1%, and I've lost 3% here, I've lost 3%, and that very particular two setup I won gave me 7%. One of them gave me 1:4, one of them gave me 1:3. And then at the end of the whole day, I have 7%. Reduced minus the 3% for the 27%, we have 4% left. And that is how you can stay on profit. So you need to understand that this particular thing all boils down on a proper risk management. If you fail to keep a proper risk management, no matter how good that your strategy is, the moment it fails one or two, three times, you are going to have your account blown. But if you understand this risk management very, very well, everything will start working very, very better. Okay, so please, I'm going to be ending the lesson here. Don't forget to leave a subscription below, like and subscribe, share the video. I'm pleading on you, share the lesson, and then try to comment, leave your question on the description below. I'll always be there to answer your question. Anything, I'll always be there to answer. Don't forget to also subscribe to the YouTube channel. I believe that this very particular lesson was enough to enable you to understand that these are the things that have been keeping you unprofitable. A word is enough for a wise. The only thing left for you to do now is to go to the chart, practice this thing, backtest, backtest, backtest. When you see it on the chart, stay away from it and then try to do the right thing. Don't attach any emotion to forex because you are going to sell. Number one thing, that this thing does not even know that you exist. As it's going up, it doesn't care where your stop loss is. It's going up to favor somebody else. Okay, that is what you need to know. So for now, we're going to end the lesson, and thank you, and may God bless you.